Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing a titan in this sector, Luke Gromen of Forest for the Trees. How you doing, Luke?
I'm doing well, Darrell. Thanks for having me on.
Yes, I say a titan. I've been listening to you for a while, so every time I get in front of some of my favorite analysts, I always have to pump y'all up and everything, right? So,
Appreciate it.
so obviously the signal right now is Strait of Hormuz is still closed. It's there's been some noise here and there, regarding the blockade, and then I think President Trump said, "Oh, we're not doing any more attacks," because I think there's like a 60-day window where Congress has to approve like a war and such. And so there's all this noise that's happening, but the strait is still closed. And so I'm curious in your thoughts on. Do you see anything breaking? What cracks are you seeing? Obviously, we see that in the energy sector, and just want to get your thoughts on any other sectors or commodities that you're seeing that are impacted from this.
Yeah, it's been it's been a case of, based on what we had heard 3-4 days into the war, we said, look, I think Hormuz is gonna be closed a lot longer than we think, and to me, it's really the only factor that matters in the market right now, and you're starting to see it's slow but accelerating cracks in supply chains. It's shown up as significant inflation that is just now starting to be passed through. 20, 30, 50, 100% price increases I've been hearing about from people in that the petroleum based supply chains. We've seen it show up in inflation for fertilizer and fertilizer availability in some parts of the world. That will ultimately result in lower crop plantings around the world, higher crop prices around the world. Unfortunately, in some places of the world, poorer parts of the world, probably outright food shortages. You're starting to now see it for the first time in developed world airline. Obviously, we had Spirit Airlines file bankruptcy, which is, to me, sort of or closed down, not even file bankruptcy, closed down over the weekend. To me, that's almost like the 2007, we started having some of these sort of, crappy fly-by-night mortgage companies, closing down and going bankrupt. That was kind of, your leading indicator of a problem. And I there's lots of great people who work at Spirit Air. I don't want to denigrate them in any way. I'm just saying, from a financial position, Spirit Airlines was one of the weaker players in the industry. And so you're seeing that. You're seeing, so far, I saw just this morning, Financial Times, 2 million seats, about couple 100,000 flights, maybe 100,000 flights have been canceled beginning in May by global airlines. And here too, when you look sort of top to bottom, it is starting with Asian and Near East airlines, Turkish Airlines, some Asian airlines. Actually, British Airways is pretty far up the list, as apparently Britain imports a great deal of its jet fuel. But it's, in the grand scheme of things, it's, the flip side of this, hey, it's only, 50 basis points or 100 basis points of total global seat capacity. Yes, but that number isn't going to go up linearly come June, if Hormuz is still closed. It's going to go from, 50 basis points, 100 basis points to 500 basis points or something like that. And then that starts to break. And that's really an important one because, as I didn't know until COVID, but I learned in COVID, travel is about 10% of global GDP. And so when you start interrupting travel, it starts having these second, third waves. So we're seeing the early stages of this breakdown occur. You're seeing global bond markets respond to rising inflation. And so that's kind of where we are as it relates to the second derivative implications beyond just oil prices.
Yeah, I mean, for me, it's pretty astounding just looking at this whole thing, and I know that we don't have to get too political, but Donald Trump did run on blaming inflation on Biden, right? And in this scenario, in this situation. I mean, technically, the Strait of Hormuz was not broke. We went in, we went in and wanted to fix it, right? And the administration is doubling down on like them having access to nukes and such, and so and that's kind of the main theme that I've been seeing, and such, and so. Yeah, I mean, how is this going to look? I mean, yeah, midterm implications here in the U.S. You have, the average person that's still struggling. I've been reading a lot of articles that have been coming out about, people's affordability issues and such. And so it seems like it's going to make that issue even worse.
Yeah, I think that's right. And for me, it's been something I've been pretty confused about. There's a view that this is sort of a, 2D, 3D, 4D chess move to sort of shut down the strait and attack China's, supply chains. And, but again, it's like, to me, that's like the scene in The Simpsons, right? This is going way back. I'm dating myself, but like Homer's driving through this dense fog and he can't see anything, but he's just driving on away. And then all of a sudden there's a car in front of him stopped and he rear ends the car in front of him. He's like, oh, don't, he gets out and he looks at the other car's bumper and he goes, well, at least I got him as good as he got me. And then he walks a little further and he sees it's Marge's car parked in front of his own house. He's like, don't, so it is where I keep coming back to, and I've probably not vocalized this or expressed this as well as maybe I should up to this point, which is when you look at the debt, dynamics that the United States is in and went into this war in, there have basically been, you can go back in history, there have been no countries going back 150 years that have had debt to GDP hit 130%, 125% like we did during COVID, and not have a debt crisis of sorts. A severe inflation usually is how it's worked out with severe financial repression. There was one example really in the last 200 years that I'm aware of where a country was able to do that. And it was Great Britain after the Napoleonic Wars, I want to say like 1815. And so they had the reserve currency, it was gold backed, and they were able to not have to devalue their currency to get out of their debt issue. How did they do it? They cut government spending drastically. They had some of it probably by luck of the draw. You were at the very beginning of the industrial boom, right? Industrialization, etc. for the next 100 years. But, then you steam engines, and then you get into commercialization of fossil fuels, etc. And by virtue of growth, cutting government spending, and avoiding, they didn't go back to war in any real way. They were able to get out of it. And you contrast that with what Trump just did, which is, okay, we have a debt problem. We had a debt problem. We had an inflation problem that, yes, it was an inflation problem under Biden, and it was ultimately an inflation problem that was a manifestation of a debt problem. Because part of the reason we ran the additional stimulus is we absolutely didn't need on the surface in 21. We didn't need the second and third rounds of stimmies, but if you go back to August of 2019, there was a BlackRock white paper called, it's like Navigating the Next Crisis, wrote about it at the time. But at any rate, the point was it was three former central bankers, including Stan Fisher, former vice chair of the United States. And the gist of it was, look, in the next crisis, we're out of firepower. And so what's going to happen is we're going to have to do a lot of fiscal spending, and central banks are going to have to monetize that fiscal spending to keep interest rates well below the rate of inflation to grow out of the debt to set us up. And so the Biden inflation that Trump criticized that you were noting was really, in my opinion, a policy response that was laid out in 2019, which was, hey, in the next crisis, we're going to spend a bunch of fiscal, and we're going to have inflation, and we're going to keep bond yields low, and we are going to grow our way out of it. We're going to inflate our way out of it. And that's what I think 2021 was about. You get to 2022, of course, it starts to become a political issue. And to your point, like now gasoline prices where I'm sitting in Ohio, they're higher than they were in 2022. I just saw a $5.99 diesel in Cleveland, Ohio, last night. That's going to filter through to all sorts of supply chains, and it's higher than it was under Biden. And incredibly, we haven't even gotten to the really painful part of this yet. So like you've got inflation baked in the cake across necessities that is going to be very meaningful for the next 6 to 12 months. And it sets up a real interesting dynamic of, are we going to save the currency, right? Are we going to essentially let bond yields go to where they need to go? Is the Fed going to hike rates to defend the currency? Or are they going to cut rates into accelerating inflation and really let the currency go and let inflation go? And we're in this interesting moment in time right now where the stock market and even Bitcoin a little bit seem to be thinking over the last 3 to 4 weeks that they're going to let the currency go. And the bond market, with the 30-year, breaking 5, the 10-year back to its 4.4, over 4.4%, which has been a problem area that we've seen various jawboning, tacos, etc. since this war started. The bond market's saying, no, we're going to defend the currency. They're going to save the bond market, not the currency. They're going to let everything just, come unwound and let rates go as high as they need to go to stop the inflation. And only one of those two could be right. So, it is a very interesting time from that standpoint, because look, if the 5D chess people are right, maybe this could all work out. But generally speaking, disrupting supply chains is a really bad way to try to, win a game, right? It's almost like the Strait of Hormuz strategy. It's like, okay, well, it's, Alabama against Ohio State, and, it's halftime, and Ohio State's down 28-7 to Alabama. And Ryan Day is like, okay, here's what we're going to do, guys. I know our quarterback is not playing well. I know our running back's not playing well. I know our line isn't blocking at all. But what we're going to do is we're going to have the quarterback go, and he's going to throw footballs and knock over Alabama's Gatorade, so they don't have as much Gatorade, because that's why they're beating us. So like, no. It's because your quarterback's not playing well. It's because your line's not blocking. It's because your running back, has a busted leg. Like, and so sort of throwing a football at the other team's Gatorade supply is how I think the Hormuz strategy is. And like, it might make you feel better. Maybe it'll work. Maybe Alabama's entire team will get cramps and not be able to play, and then we can run against them in the second half. But boy, maybe we should just draw better plays. Maybe we should see if the second if there's some freshman running back or quarterback who can play a little better, something like that. So it's a really interesting time. I think it's coming to a head very rapidly. And I think every day now that Hormuz stays closed is worth like 3 days that Hormuz was closed, 2 months ago, in terms of, because we've run down energy inventories, oil inventories, we've run down other inventories. Companies are now starting to see they're actually getting out and sending reps around, hey, we're raising prices 40%, effective today. Boom. You don't like it, you're not getting allocation. These conversations are happening now. So, let's see.
We got all of the boxes ticked, and now we have one of the only shovel-ready permitted projects in the US.
It'll be Wyoming's first permitted mine. Is this correct?
It'll be the first one in 100 years. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Yeah, earlier you mentioned the gas prices. I was thinking about just where I live in the Seattle, Washington area. It's been getting really expensive, and I keep recalling these kind of stickers that people would put on the gas pump where it would say like it would show.
I
Biden.
did this, right? The Biden stickers.
yeah. It's kind of interesting. I wonder if the reverse is going to happen. So just curious, from an investment standpoint, who wins in this inflationary environment? So obviously we see, fertilizer, energy and such, and many people have been talking about energy sector. We've had many talk about the energy sector. So just curious if there's any other winners in this particular environment.
I think the energy, the XOP type names, E&P names should do well, particularly if they get convinced that these prices are staying here, and B, they're forced to do it. Trump implemented the Defense Production Act as it relates to petroleum production 2 weeks ago or 10 days ago. I think that potentially could come to be pretty important. I am not a lawyer, so take this with a block of salt, but when Obama signed an updated version of this in 2012, there were a whole bunch of people at the time going, oh my gosh, this could actually, they could just force people to do things. And so I think we're going to see that in the energy space, where the U.S. government is going to buy, carrot and stick, right? Hey, listen, produce more. And there's ways you can do that, right? The break evens now, you can make money doing that. We've seen some comments out of energy execs in recent days saying, look, we're still, I believe it was ConocoPhillips saying, look, we're still going to run this as to maximize cash flow and to maximize margins. We're not going to run this to maximize volume. There's ways you can, Trump can come and say things that make them do that or incent them to do that. Something they could do incentive-wise would be, listen, we'll cut all your taxes on anything you produce, so produce more, your profits will be the same, your production will increase. You could do that. And that's going to be a political issue. That's throw that on the pile of growing pile of political issues that Republicans are going to have in the midterms if you and I are paying $6 at the pump and oil companies have had their taxes cut to zero so they can produce more. It's I can absolutely see that happening, something like that, right? So there's ways you can do that. There's more draconian ways that the Trump administration could do it, which is just produce more. And if you need workers, we will send guys from the 1st Infantry Division to go work in the fields, and there's a ramp up time to that, but that's if you need labor, we will supply you the labor with the U.S. military, or we'll call up parts of the National Guard reserves in your area, and they will go to work for you. Something like that is something you could conceivably see with that DPA invoked.
That would suck, getting military wages, going and working in the oil field.
Yeah, that would be a kick in the shorts, right? You're making, whatever an infantry enlisted guy makes now, which is not nearly enough. And, the guy next to you who's, the roughneck's probably going to make 220 grand. Yeah, that's a little unfair, but that's the way the cookie crumbles, I suppose. And the DPA, they can do that, Defense Production Act. I think another thing that Trump invoked, the Defense Production Act, U.S. electrical infrastructure, something we've harped on a lot, and everything that feeds into that. So, things that companies that occupy the ETFs, like the PAVE ETF, PAVE, or the GRID, GRID, you look at the companies in those ETFs, and I think that sector is going to do very well. We are short electricity. A lot of the manufacturing boom that we are having, as it's being called, it's mostly in AI right now. There's actually not that much else really ramping. That might be changing on the margin. And it's interesting. I have a private equity investment in electrical infrastructure. I was talking with someone close to the management team 2 weeks ago, and he goes, "Look, the management team's saying, the Trump administration doesn't seem to understand that the bottleneck's labor. The biggest bottleneck is labor. So he can tell us, hey, we're going to give you full force of the U.S. government behind making more electrical grid stuff, but until you can get us workers in the plants, then we're going to be flow limited, and that's inflationary. It's inflationary for wages, which then goes back to the whole bond question, which is, are we going to let rates rise, or are we going to have a Fed chair when Warsh comes in who's just going to cap yields? And equities are saying, yes, he's going to cap yields. The dollar is sort of and the bond market's like, no, he's not going to cap yields. I think nuclear, that supply chain, broadly speaking, structurally is in a very good position. I think the world, you saw von der Leyen in Europe come out and 10 years too late go, well, maybe we shouldn't have closed all our nuke plants. It's really, you think? So there is an awakening around of realism around nuclear, and that's something I think that will last that's a very long cycle business, in the beginning, or in normal times. I think it's going to continue to be so. But I think there's a secular tailwind there as well within the nuclear supply chains. Yeah, and I think those are, for me, those are, copper, obviously, and that's when you talk about the commodity side, electrical infrastructure, copper, nickel, those types of things, rare earths, they all sort of fit the critical minerals that fit into that. I would define very broadly.
Yeah, I want to come back to those rare earths and other critical minerals. So the UAE decided to leave OPEC. Does this position the West in any type of way with as far as like energy production or whatnot? I know OPEC has always been kind of like the group that everybody would do business with, and so what does this mean? Is this significant in any type of way?
It might be. I don't know. I've seen a lot of different takes on that. I am not an expert on the intricacies of intra GCC rivalries, right? So I was reading from a friend of mine that there's rivalries between, say, Saudi and Abu Dhabi and what have you, and that are very sort of subtle to the Westerner. We just kind of look at it all as like, hey, the Gulf is shut and they're mad at Iran, and so they're going to all side with us. That's kind of like the Western view of what's happening here, and it's not nearly that black and white. Is everything I hear. So within that, with UAE, it's interesting. I think the Occam's razor explanation, I think, is that they leveraged the position they had. I guess they've got decent size investments in U.S. infrastructure on gas export. And so they're less hurt by what is going on than those also trapped behind or more trapped behind the first blockade or both blockades. So I think they are probably doing a pretty decent job of is probably doing a pretty decent job of playing both sides, which is to say, they a couple weeks ago, the UAE went and announced that, look, we need a swap line. We need $1 swap line, or else we'll start pricing some of our oil and gas in Chinese yuan. And that was an interesting statement. And shortly thereafter, Besant came out and said, yeah, we're going to give them a swap line. And now over last weekend, you had, different people in either the CFR magazine or the Journal saying, well, we shouldn't give them Brad Setzer, who's an expert on supply chain or on pipelines, say, well, we shouldn't give them or at least tweeting it out, Setzer did, we shouldn't give them these swap lines because they're rich and they don't really need it. But their wealth is likely tied up in dollar assets heavily, right? So essentially for them to, they have a business, they sell energy in dollars. Their ability to raise, to create dollars or to via energy production has been impaired. And that leaves them with a choice. Do I sell dollar assets or do I borrow more money? Do I get $1 swap line? And when push came to shove, they said, look, we're, either give us the $1 swap line or we'll start moving some of our business over to the yuan. And I think they leveraged that position. And I think it's possible, if not likely, that part and parcel to Besant saying that is the condition that they leave OPEC. And, it's possible that it's just as simple as they want to leave OPEC now because they can run up production, and at higher prices, possibly. And maximize whatever they can get out. So, I think it's too soon to tell I think it could be significant. It might not be. I'm not quite sure. I mean, bigger picture, it's interesting to me because OPEC was in some way really gained a lot in power and really became much more necessary after the dollar went off gold in 71, which is to say, if the U.S. going off gold is basically, hey, we're just going to create dollars willy-nilly, if that's the case, if dollar supply is going to grow significantly, then if you have a finite oil production in your country and the others do in that region, and then it suddenly becomes important to manage the price of oil, to create a cartel, to really enforce a cartel. The cartel was already created at that point, but to really enforce a pricing cartel to make sure that you manage the purchasing power of your oil in dollar terms over time, right? And so you can see from 73 to 03, significantly contributed to by OPEC, the OPEC cartel management of the oil price. Dollar oil, the dollar price of oil traded between $15 and $25 for the vast majority of the time from 1973 to 2003. I mean, that's 30 years. That's a long time in markets, especially. So when I just take the step back and look at it from that big picture of the UAE leaving OPEC, is OPEC breaking up? Maybe. If that happens, that potentially says something about the post-$71 system, whereby OPEC was managing oil prices in support of the post-$71 system. Whether it was intentional or not, I think it was intentional, obviously, certainly as it relates to Saudi in that arrangement as the big swing producer. What does that mean going forward? It might mean nothing. It might just mean that it's breaking up and that Bessent and Trump see this as a way for OPEC to basically everyone for themselves, and then oil prices are going to fall, and that hurts Russia. Possible. Or it could be part of some broader deal where essentially, look, we're moving away from the post-$71 system, which you kind of have to when we're such a big energy producer, right? Mm-hmm. And if that's the case, this might be an advance warning of that. So to me, it's too early to make a concrete conclusion, but those are the things as I watched it that are sort of rattling around in my head, both tactically and then bigger picture strategically.
Yeah. Thanks for sharing that. Just looking at China, so the yuan keeps coming up. I think even Iran mentioned trading oil in yuan. The UAE came out and threatened to sell oil in yuan if they don't get the dollar swap lines and such. And so I do want to talk a little bit about China. So China recently said they were doing a export ban on sulfuric acid, which is used in nickel mining, copper mining, zinc mining, uranium, all of those. And it has, this has impacts on fertilizers as well. And so just curious in your thoughts on this particular move. And then, we'll focus on just that first. And then I have another part I want to piggyback on that one.
Yeah, I suspect it's probably some sort of leverage, right? Because one area, everyone is so focused on China's energy vulnerabilities, and while they are there, there's a pretty long list of U.S. quote-unquote allies that are going to go sort of over the cliff well before China, because China has one of the biggest, if not the biggest, strategic petroleum reserve in the world. So, but one area I think that seems like China is potentially vulnerable is helium. They've been trying to increase helium production domestically, and they're sort of getting there, but it's not ramped up nearly to what they need. And in the meantime, the Middle East is a big producer of helium, and the United States is the world's biggest producer of helium. And so I can't help but think, obviously we've heard a lot about the rare earth situation now, and there's a view that part of what we're doing with oil is trying to choke China's oil to get access to rare earths. The Chinese holding off sulfuric acid is going to choke off the production of sort of everything we need, not choke off, but flow restrict is a more accurate term. Flow restrict copper, nickel, all of these sort of metals that go into the electrical infrastructure that we need in order to build out our grid, build out AI, not just in the U.S., but globally. And so I think it might be sort of a tit for tat response. Rare earths, oil, helium, sulfuric acid, and ultimately that is. I think it's very possible, and I think it's really bad for global trade. I think it's really good for inflation. I think it's really bad for global bonds, either nominally or but on a real basis certainly. So that's and it's something where Craig Tyndall, my friend Craig Tyndall, did a great piece on sulfuric acid specifically on X. I don't know, probably 3-4 weeks ago, shortly after China announced it. And I'd encourage everyone to go find it. It's Tindale.
I think I bookmarked it. I gotta go.
It's really good. Yeah, it's really good. And it just lays out, like, the complacency around it in markets is still pretty astonishing to me. There's still the view that, hey, this is all going to be over soon. I'm not sure it is. And the importance of Craig's thread is that it just chapter and verse pulls a thread of, okay, a month in, sulfuric acid supply is down this much, you're going to see here, and then it's going to fall to here, and then it's going to hit here, and just right on down through the supply chains around the world. And it really is like the old poem, for want of a nail, the shoe was lost, for want of a shoe, the horse was lost, for want of a horse, the rider was lost, for want of the rider, the battle was lost, for want of the battle, the kingdom was lost. And so the whole kingdom was lost for want of a nail. And that's kind of the dynamic, that's kind of the power of what sulfuric acid is. It's not that there won't be any. And this is something I think people are really, really missing still. There's this, oh, it's not like there's going to be widespread shortages. No, they're like, well, demand will be rationed by price. Yes. And that's where they stop the thought process. But there's another part, which is the price that this stuff, whether it's sulfuric acid, whether it's helium, whether it's oil, whether it's gas, whether it's copper, the price, food, whether the price that this stuff will go to ration demand appropriately is or will blow up the global financialized markets and economy. The bond yields you need to maintain real bond yields relative to the price that prices will go on a basket of this stuff in order to ration demand. The bond yields there, the Western governments can't afford to pay. Russia can afford to pay it. China can afford to pay it because China's yields are going down in all of this. They're in deflation. So that's the that's the dynamic, the third derivative dynamic of all this that is still, to me, not being focused on enough.
Yeah, that's very, very interesting, especially just thinking about the cover-ups. It seems like this tit for tat, like you mentioned, but China could say, oh well, the closing of the Strait of Hormuz, is leading us to secure our domestic supplies or something. There's always some type of face you can kind of you can put all types. Oh yeah,
the Chinese are famous for that. People this whole war have been like, oh, the Chinese haven't done nothing to fight back. It's like, that's not what the Chinese do. Like the Chinese, you punch the Chinese in the head and they're kind of like, oh, and they turn around. And then you're like, okay, hey, where's my rare earths? And they're like, oh, well, we have produced it, but this is substandard, and so we can't ship it, and we need to have 14 more layers of bureaucracy before it can leave, so you're going to have to wait. And that's how the Chinese respond to this kind of stuff. It's like, the dog ate my homework, the dog ate the rare earths, right? Like, yep, and that's how they get back, and then they just let compounding interest and your bond, the bond market, do to you what it's going to do to you. Empires are winless. So compounding interest is undefeated all time against empires. Empires are winless all time against compounding interest.
Mm-hmm. Yeah,
the U.S. empire has a compounding interest problem, and the Chinese know this, and they just keep weaponizing it, and we keep doing nothing about it.
Mm-hmm. Yeah, definitely. So with this ban on sulfuric acid, I'm thinking about silver, because silver is a byproduct out of many of these copper mines, zinc mines, nickel mines, and such. And silver's already been has tight supply. It's been in a deficit for multiple years. Even China had their highest level of silver imports in 8 years. And then they also have some limitations on exporting refined silver and such. And so curious if you see silver in a certain light with this type of ban or these dynamics.
Yeah, it is. I had a friend of mine sent me a fascinating write-up. This was probably in December, maybe, from a retired long time, I think he was a CME guy, but at any rate, it was one of the more fascinating emails I've ever read, because it just went chapter and verse on the supply deficit that you discussed, right? Like, here's where the U.S. Geological Survey is saying supplies are, here's where they're saying what recycling is, and here's the balance they're getting to. But their numbers are highly suspect, because if you, the solar panel industry puts out very detailed, here's how many installs you have in the U.S., around the world. We know with pretty high degree of certainty how much silver is in each solar panel. And when you do that math and then you throw that in there, and then you throw in some EVs and you know those numbers roughly, and then you throw in some cell phones and some of these other things that silver are used in, and you come up with this demand number that is like, I mean, the number that the Geological Survey was coming to, you almost can't get to their number. In other words, demand was just so much higher than supplies, and has been for years, and you've got this ramping in EV, et cetera, and then you layer a war on top of it, where silver is in some measure used in a lot of these weapons that we've been using, and that just adds to the issue. And this was right around the time silver went from whatever 70 or 80 up to 125 pretty quickly, and came back down. So I've not spent a lot of time on silver since. I didn't, I have always had a small position. I didn't sell any up there. It's physical. I just sit tight basically with it until I really feel like it's more fully priced, I suppose. But I go back to that write-up and I kind of go, okay, well, what's changed? Well, if anything, everything that has happened in the Straits, we're seeing worldwide stories of EV adoption rising rapidly. Okay, well, that's a greater call on supplies. On supplies. Solar, you're seeing more installs there. Okay. Weapons, everything that was sort of contributing to this strong demand picture is increased in the last 4 months. And so, to me, what is silver going to do in the next couple of months? I don't know. What do I think it's going to do in the next couple of years? I think it's probably going to go higher. And quite possibly quite a bit higher, because I just look at this and go, I don't see how, the math ain't mathin', as they say. So that's how I think about silver. And then, to your point, the sulfuric acid. You're talking about the demand side has risen, but now you're talking about quite possibly the supplies, right? It's a byproduct. Silver is a byproduct of some of these other processes, which are being flow restricted by the lack of sulfuric acid. Copper mining, for example. Okay, you start restricting copper mining around the world, you're going to start restricting silver output into a demand situation that's accelerating into a supply-demand balance that was already skewed in favor of demand 4 months ago when this all started. So to me, I think silver probably is a lot higher in a couple of years. In the short run, it's also a critical mineral. It was designated as such by the U.S. government whenever, October of last year, I think, maybe in November. And we're in the fog of war, and prices convey information. And I have seen things that I have thought have been the management of price information during wartime in the last several months. I know of several instances where that is absolutely happening. And that's just the nature of the game, and that is what it is. And that's fine. I think, just needs to inform investors of it. Hey, I'm not saying the price is completely disconnected at all times. I'm saying you should, as an investor, expect the disconnection of price and value to occur at times and to adjust how you buy, sell, etc. accordingly.
Yeah, for sure. What are the risks to some of these metals? So I've been in position in copper for a while, as well as silver and some of these other commodities. But the risk of like global slowdown, recession, and such, that still kind of looms over my investment thesis. That's like the dark cloud that's still there. And so curious in your thoughts on that.
Yeah, I was listening to something. Grant Williams interviewed Simon Hunt last weekend, and Simon said, "Look, with Hormuz being closed, even if it opened up tomorrow, we're at risk of a global recession. And if this thing stays closed for too long, it's not too strong a phrase to consider a global depression." And I think he's right. Craig Tyndale's work suggests the same in terms of supply chain implications the longer this drags on. And that is, I think, the big risk for commodity bulls, which is this does lead to some sort of nonlinear breakdown. And it doesn't take much. You get a global recession, you're going to get something similar to what we saw in COVID, I think, in a lot of prices. And that's going to be a super tricky time because the debt position of these governments is you can't have a recession. If you have a global recession, US, UK, Japan, Europe, they are all in a position of they would have to print, or they would have to cut all their entitlements and defense spending, or they would have to print the money.
Yeah.
China has a little bit more leeway, but not much. And at the end of the day, they're tied at the hip. So that's the reason why I think it's tricky. Is I do think you're setting up the risk of every day this goes on of demand destruction as something to sort of keep. I wouldn't sell commodities here and that because ultimately, I think there's zero chance that these countries are not going to print money into that. I think it's more a position management slash. Sometimes I'll get, hey, why would we want to be all in silver or all in copper? It's like, well, like just, be cognizant of exactly what you're describing, which is every day that goes by and Hormuz is still closed, a global recession, if not worse, becomes more and more and more likely. And that's just reality. And I think people looking at nominal GDP numbers are going, oh, no, it's fine. It's like, if you can't get the product, your factory starts slowing production, and that factory slows production the next one. There's a daisy chain into a highly leveraged system. That's the dynamic I think that people are underweighting at this point.
Yeah, for sure. Okay, so lastly, I want to get your thoughts on gold and gold's performance or lack thereof in this particular scenario.
Yeah, I think gold warned us ahead of time on some level in sort of the run up ahead. Tactically, the technicians that I watch and respect saying you could have gold pull back into the high threes and everything still be totally fine, even in the mid threes, 3,500, something like that, and still be totally fine from a longer term perspective. I personally, I'd be surprised if it got that low. But I'd be buying a lot more if I woke up one day and found it there, given sort of the outlook for global sovereign debt and what's happening. So I think we're getting some of this. It's been interesting to me. Article just came out last week. Global central banks bought more gold last month than they have, I think, in several quarters. So on net, global central bank buying is really, really strong, and yet the price fell. Well, I think you're having some selling throughout the developed world. GCC nations are big gold holders, and so there's probably some selling there. And so I think you're in kind of a no man's land right now of just waiting for the same dynamic that I was talking about before, which is this war is going to force us to either force Western policymakers to save the currency or save the bond market. And, stocks are trading like they're going to save the bond market. Bitcoin's a little bit trading like they're going to save the bond market. bond market's trading like they're going to save the currency, and gold's a little bit trading like they're going to save the currency. And I think it's really just an order of operations. I think there's zero chance they're going to save the currencies. I think they're going to print as much as they need, and that's really good for the real value of. It's good for stocks, it's good for Bitcoin, it's good for gold. It's bad for bonds on a real basis. I think they'll basically be capping yields to do that. But until that decision is really made, then gold is like, it's kind of in the same, I think it's going to continue to kind of be in this sort of, no man's land until it goes ultimately, in my opinion, much higher. I think later this year, when it becomes clear that the only answer is save the bond market and throw the currency under the bus.
Yeah, we've definitely seen gold just hang out in no man's land for a number of months, then makes a significant move one way or the other. The last couple of years has been significant moves upward, and so it's definitely going to be interesting to see that. So I'm interested in your thoughts on gold as a long-term asset, and you mentioned this quite a bit on your X account, where when people quote the S&P's performance, and then you measure that in gold, and you see that the S&P isn't performing very well when you measure it against hard money, hard asset. And so, curious in your thoughts on gold longer term.
Yeah, I think we're into a stage where when we just take a step back from, hey, are we in are they going to save the currency or the bond? Like, we know what they're going to save, right? They're going to save the bond market and throw the currency under the bus. So to me, the only way out of this is severe financial repression, much higher gold price. And I think ultimately we're in one of these cycles that we've seen several of. We saw it in the 30s, we saw it in the 70s, we saw it in the 2000s a little bit, less than in the 70s, but where you get 10, 12 years where gold just really outperforms. And I think ultimately gold probably on the S&P, I think it's what, it's 0.6 now, something like that. I think it goes, in generational lows, gold to S&P has gone, or S&P to gold, has gone to 0.1, 0.2. So to me, I think at S&P to gold at 0.2, gold to S&P at 0.2, I guess is the right one. Yes. No. S&P to gold at 0.2.
Yeah.
I think that's kind of, I think that's where it's going to go. And the reason I think that is ultimately, not only do we need to devalue the debt, but when we look at what the Trump administration is doing, Defense Production Act for petroleum and infrastructure, you're basically printing money to reshore. That is a fundamental change of flows of the global trading system. That means you cannot use U.S. Treasury bonds as your primary reserve asset going forward. You have to use something else. And the only other thing that is big enough to run the deficits is gold. So people always ask, well, what's going to run the deficits if America's not running the deficits? And I point them to, it's not even speculative, it's a fact. Gold's going to run the deficits. Gold is running the deficits. We can see this. Gold's share of global FX reserve is now bigger than U.S. Treasury bonds. And these, critics will say, oh, it's all just gold price. I say, exactly. That's the point. The same person that says, well, it's just gold's price, it's not gold tons. It's like, do these people count their 401k in number of shares they hold? No, of course they don't. They count it in what the money they put in and what's the S&P done. That's how they count it. But for some reason, some people go, oh, well, it's just all because of gold's price. No, exactly right. Gold's price is going to go up, run the deficits, basically become big enough to be the reserve asset as the U.S. reshores. That's a really good outcome for America. That's a really good outcome for the world. Let's see if we can continue on the path. Maybe this whole Iran thing is just political cover for it. I don't know. I tend to not give them that much credit in terms of trying to plan the unplannable. But
yeah, for sure. So, Luke, would you would you be interested in, so if the S&P to gold ratio went down to 0.1, would you trade some gold for the S&P?
Oh yeah, for sure. I would be trading it before that. I would, it'd probably be scaling. Gold's an overweight for me, and has been for a long time, a significant overweight. And so yeah, I would be scaling some in at probably 0.3, probably at a lot at 0.2, just because I'd be surprised if it actually got to 0.1. But I would never sell all my gold, just because. What would Ray Dalio say? If you don't own gold, you know neither money nor history, or you don't understand economics or history. And I think that's right. Is ultimately, for me, it's all about what's the price of things, in gold, and to a certain extent in Bitcoin. If it ever, as volatility in Bitcoin comes down over time, you can have that same discussion about Bitcoin. People have asked me the same about treasury bonds. At what price, what yield would you buy 10-year treasury bonds? For me, it has nothing to do with the yield. The U.S. government can't afford over 4.8%. So it's like how many whatever can you stand on? How many camels can you stand on the eye of a eye, or on the head of a pin, or whatever? Right? How many angels on the head of a pin? Who cares? It doesn't matter. It's a silly discussion. Now, what's a good discussion, in my opinion, is at what price of the dollar would I buy 10-year treasuries? So look, gold at $15,000, $20,000 an ounce, I will happily buy 10-year treasury yields at 3%. I'll sell gold and buy 10-year because the dollars that I will be receiving in interest and holding in that bond will be properly valued relative to the amount of debt and what have you out there. That's how I think about that. And from the S&P standpoint, given that everything's kind of a derivative of treasury markets, and same kind of dynamic. I will happily sell gold by S&P when S&P is more appropriately valuing the dollar relative to gold, given the fiscal situation of the U.S. and the West more broadly.
Yes. Thank you for your thoughts on that. And then just one last thing. What's your thought on being liquid right now? Like, are you holding liquidity as well? Or?
Yeah, very. I have now caveat. I've been underweight equities for this run up for the last month, so that's been wrong. I'm losing no sleep about that though. I still have a little bit of Bitcoin, so that's that has helped respond to that. But yeah, I am still significantly overweight cash, T-bills, and gold bullion, which is ultimately very liquid. So I am between Hormuz being closed longer than expected, right? And to me, it's been fascinating to watch the narrative creep on this, right? It's like, well, it's not going to be closed for long. Well, it's not going to be closed for much longer. Well, even if it's closed, it's actually good for us because it hurts China. Well, actually, we're going to close it too. And so like that to me is like, so let's just stick with the facts. Hormuz is closed way longer than anybody thinks. It's going to have a real economic problem. Then I look at where valuations are, and I'm not a huge valuation guy except at extremes. And, for example, in 2018, people were pointing out the Warren Buffett metric, which is total equity market cap as a percent of U.S. GDP. He famously said 99. I think it's the best, one metric to sort of manage, to view where equity valuations are at any given point in time. And he was dead right. In 2018, the Warren Buffett metric, total equity market cap over GDP, hit the same level as 1Q 2000. And a number of people said, oh, that's it, it's over, you got to be bearish. And I actually wrote at the time, no, you got to stay bullish because we're now in the QE era. We weren't there in 99, 2000, which is to say the U.S. has a debt problem. And any time the stock market goes down, the debt problem starts to spiral. And so the fact is my view at the time, it's become empirical facts, we've seen it happen and play out correctly a number of times, is the Fed will monetize or support the Treasury market as much as they need to in order to it's kind of become their shadow third mandate. And so my point was in 2018 was you can't look at the unadjusted Warren Buffett metric of total equity market cap divided by GDP. You have to look at total equity market cap minus federal debt all over GDP. And by doing that, you're basically saying, okay, well, they're going to buy at least some of the debt in a downturn anyway. And so let's just set that aside and see where we are. And in 2018, what the adjusted Warren Buffett metric said, we still had 60% upside to get back to 1Q 2000 levels. I guess on aggregate, the S&P 500's gone up 60% since 2018. Wow. So here we are, exiting 4Q and into 1Q 26, 4Q 25 into 1Q 26. The adjusted Warren Buffett metric reached an all-time high. It's higher than 1Q 2000. And the only other time in at least, I think since the Great Depression, 1929, that it hit this level was in 4Q 21. And the S&P had a terrible 2022, certainly for the first 3 months of the year. So I just look at, okay, Hormuz is still closed. The adjusted Warren Buffett metric is telling us we are in la-la land, bubble land that we've only seen 2 times in the prior 80 years, and both prior times have been terrible times to own risk. And 3, I keep hearing from highly credible sources that the war's not going as well as we think. And as a result, Hormuz is going to stay closed longer than we think, and supply chains are going to start breaking down more than is being reflected by all this. So to me, I look at all this and say, I want to continue to have liquidity. That's why I say I slept just fine as I watched this rally, whatever, I think 12% off the bottom S&P rally, which is not nothing. But I look at sort of the underpinnings of it and go, and I'm not that, there's areas I'm still very excited about within, but from a headline perspective of equities, I'm still very, very liquid.
Yeah. Appreciate those thoughts and everything. Well, Luke, where can folks go subscribe to you and where you publishing and all of that? Plug the audience.
No, I appreciate it. If you're interested in hearing more about our institutional and high net worth and mass market product, check out FFTT-LLC.com for more information. And then I'm on X as well at Luke Gromen, LUKEGROMEN.
All right. Appreciate you, Luke, for coming on the show. You all be sure to hit the subscribe button if you haven't subscribed yet. Love to have your support there. And thank you for watching.